Ever feel stressed out watching your investments go up and down, unsure if you're making the right calls? Bill Ackman, one of the most successful investors of our time, has a strategy that cuts through the noise and focuses on smart, stable decisions. In this video, I will show you Bill Ackman's most recent bought and sold stocks, why he is doubling down on a stock that has taken a beating, his thought process behind it, and most importantly, what does his strategy mean for your investments? Alright, let's jump right into it. Bill Ackman's biggest moves this quarter were his buys, and these weren't small casual additions. Let's start with Brookfield first. If you're wondering why Ackman just boosted his position in Brookfield by an eye-popping 377.58%, you're not alone. This is now his largest holding, making up 13.48% of his portfolio. So what's the deal with Brookfield? Brookfield is a major player in real estate and infrastructure. It is a financial giant with its hands in all kinds of stable cash-generating assets. Office buildings, renewable energy, you name it. And Ackman's timing? Brilliant. With markets teetering due to rising interest rates and fears of a recession, Brookfield offers what investors crave during uncertain times: stability. Infrastructure and real estate assets are less sensitive to short-term volatility, and they generate steady cash flows. Ackman is clearly betting that Brookfield's focus on essential industries will keep this portfolio grounded, no matter what chaos the broader market throws at us. And it's already working. Brookfield's price is up 13.04% since Ackman made his move. Now let's talk about Nike. Ackman didn't just buy a few shares here and there, he quadrupled his position, adding about 13 million shares, making Nike 11.15% of his portfolio. So why Nike? At first glance, it might seem like an odd choice, but consumer discretionary stocks like Nike have been under pressure lately. Inflation has eaten into consumers' wallets, and companies relying on brand power have seen their valuations dip. But here's Ackman's strategy. He knows how to spot a good deal. Nike is still the king of its domain. Its brand is iconic, its global reach is unmatched, and its direct-to-consumer strategy is changing the game. Sure, its stock has taken a hit recently, but Ackman likely sees this as a classic value play. When a company as powerful as Nike stumbles temporarily, it creates opportunities for long-term investors. And let's be honest, how many people do you know who don't at least own one pair of Nikes? Here's the wild card. Ackman also added a small position in Seaport Entertainment Group, making up just 0.44% of his portfolio. Now, this isn't a name that grabs headlines, but it's definitely intriguing. Seaport operates in the entertainment and leisure space, which has been recovering post-pandemic. Why would Ackman dip into such a niche company? Simple: high risk, high reward. So what do all these buys tell us about Ackman's strategies? It's a mix of defense and offense. On one hand, you've got Brookfield, a solid defensive play that offers stability and cash flow. On the other hand, there's Nike, a bold bet on a global brand bouncing back. And Seaport, a speculative move that might just deliver outsized returns. Ackman isn't chasing the latest trends or trying to predict short-term market movements. Instead, he's playing to his strengths, identifying undervalued opportunities and making concentrated high-conviction bets. Whether it's doubling down on dependable giants or taking calculated risks, his buys show a clear focus on balancing stability with growth. Now that we've looked at what Bill Ackman bought, it's time to dig into what he sold. This quarter, there were a few significant reductions. First up, Hilton Worldwide Holdings. Ackman trimmed his position here by 17.67%, bringing it down to 13.16% of his portfolio. Now, Hilton is still one of Ackman's largest holdings, so this isn't an exit by any means. But why the reduction? Think about the environment we're in. Rising interest rates are making it more expensive to borrow money, and the hospitality industry is particularly sensitive to this. Hotels like Hilton rely heavily on corporate and leisure travel, And while travel has gone better since the pandemic, there are growing concerns about how a slowing economy could impact discretionary spending on travel. That said, Hilton is a strong company. Reducing the position is likely a way to take some profits off the table while still keeping exposure to a sector he believes in long term. It's a classic move, lock in gains while staying flexible for new opportunities. Next on the list is Canadian Pacific Kansas City, where Ackman reduced his stake by a modest 0.59%. This is a small trim, but it's worth noting because Canadian Pacific has been a core part of Ackman's portfolio for some time. Railroads are typically seen as a stable defensive investment. They're essential to the economy, moving goods across major distances, and they generate steady cash flows. So why the reduction? It could simply be a matter of portfolio rebalancing. Ackman's other big moves, like his massive additions to Brookfield and Nike, likely required freeing up some capital, and trimming a small portion of Canadian Pacific was an easy way to do that without disrupting the overall portfolio balance. And same goes for the Restaurant Brands International stock. Ackman's sales this quarter highlight a few key trends. First, he's taking profits in areas where he's seen significant gains. Hilton, in particular, has been a standout performer, and reducing these positions allows him to lock in returns while remaining invested in their long-term potential. Second, he's being cautious about sectors that are more sensitive to macroeconomic pressures. Hospitality, Hilton, and railroads, Canadian Pacific, are both cyclical industries that can be impacted by rising rates or slowing growth. Now that we've dissected Ackman's buys and sells, let's take a step back and look at the bigger picture. What do these moves say about his overall strategy? Are there patterns emerging in this portfolio? Let's break it down. Ackman's portfolio is heavily weighted towards services and financials, which together make up 60.36% of his holdings. These sectors are a natural fit for his strategy, offering a blend of stability and growth. The service sector includes companies like Hilton and Brookfield, which generate steady cash flows. Hilton benefits from strong brand recognition and consistent demand, while Brookfield focuses on long-term infrastructure and real estate. Ackman's financial exposure, primarily through companies like Canadian Pacific Kansas City and Brookfield, reflects his confidence in the sector's ability to thrive in a high-interest rate environment. While rising interest rates can be tough for some companies, they create opportunities for those with strong balance sheets and access to capital, like Ackman's holdings in these companies. If you look closely, Ackman's portfolio shows a deliberate balance between defensive core holdings and selective growth plays. Brookfield and Alphabet, both Class A and Class C shares, make up a significant chunk of Ackman's portfolio. These are businesses with strong cash flows, global reach, and dominant market positions. They're designed to weather economic downturns and provide stability even in volatile markets. Alphabet, for example, is a tech giant with multiple revenue streams, from advertising to cloud computing. It's not flashy anymore, but it's reliable, and that's exactly what Ackman seems to be prioritizing in his defensive core. On the flip side, Ackman isn't afraid to take risks where he sees potential. His aggressive additions to Nike highlight this. Nike, despite its short-term struggles, remains a global powerhouse. This dual strategy allows Ackman to protect his portfolio's downside while still chasing opportunities for outsized returns. It's like building a financial safety net while reaching for the stars, something every investor can appreciate. Here's how you can apply some very useful lessons to your own investing strategy. First, it might be a good time to trim winners slightly and reallocate capital. It's easy to hold on to stocks that have done well, but sometimes taking profits and investing elsewhere makes sense. If a stock has risen significantly, ask yourself, does it still have room to grow, or is there another opportunity with better potential? Reallocating your capital can help you stay agile and maximize your returns in a changing market. Next, focus on quality over quantity. Instead of spreading yourself thin across a large number of stocks, consider focusing on a handful of companies you truly understand and believe in. High conviction investing means putting your money into businesses with solid growth potential and a competitive edge. Balancing defensive stocks with growth opportunities is also crucial. Think of your portfolio as a seesaw. On one side, you need stable cash flow generating companies that can weather market downturns. On the other side, you want growth stocks that have the potential for high returns. A mix of both types will help you stay resilient while also capturing potential gains. Want to know the most recent stocks Warren Buffett just sold or bought for $35 billion? Click the video on the screen.